Yeah, I'm losing my
Managing
edge.
losses in futures, Pete. That's what we're kicking off the new year with. And
Hey, it's rock solid. We talk about strategy, mechanics, and management. This is the follow through, so to speak, of your golf swing. This is what keeps you playing your game. So it's a great place to start the year.
Wow. What an analogy. Honestly, I love it. I'm usually the one who's bringing sports into here. But you're totally right, Pete. It's like everybody, when they get to the golf course and they got their new bag of clubs there, they want to pull the driver out and they just want to blast the ball as far as they can. And that's honestly a great analogy for futures. Everybody wants to get in, go to ES, go to ZB, go to GC or CL, these big futures,
right.
and just try to hit home runs. Right off the bat. That's a different sport. That's baseball. But, taking losses is honestly just managing in general, I think is so much more important than getting that driver out. It's working on the short game, how to keep yourself from, of course, you want to go out there and birdie every hole, but how do I make sure I don't get a double or triple bogey on any of these trades? That's if anything more important than getting that birdie is keeping yourself from those bogeys. So I love the sports analogies here, Pete. And before we get even deeper on managing losses, that free weekly commentary, you can grab that at go.thesmallexchange.com/newsletter-confirmation. That's a lot of characters. I'm sorry about that, but the internet, this is how it functions. But it's right in front of you here if you want to go get our weekly commentary every Monday, arriving in your inbox for free. It's got a bunch of statistics. As you can see, the first one here that we're talking about today has some math theory in there, the theory of losing, which I might have created myself. I'm a big time loser over here.
You are the Da Vinci of the 2020s. Yes.
I thought you were going to say I'm the Da Vinci of losing. Yeah, like no. I find new innovative ways to lose all the time. But yeah, no, this is an interesting free commentary that you can subscribe to via this link. And if you don't end up liking it, just unsubscribe. It won't hurt my feelings. I don't really care. But anyways, this is what we're talking about here in 2021. Losing trades is how we're going to kick off the year. And this is an important formula that not necessarily you need to write down or think about on a daily basis, but especially, at, like flagship moments like we are right now, where you're starting a new year, you're resolving to lose weight, or you're resolving to just be more active in general, or you want to read more books, or however you want to change here in 2021. This is something that I want to hit you with just to get in your mind. And it is this idea of, okay, I win a certain amount of trades. And on each of those trades, I'm trying to take X amount. And then, of course, with futures trading, you don't get those win rates, Pete, that are 90, 95% like you might in a lot of options trades because the markets are so fast and leveraged there. So I'm going to lose a certain amount of trades. How much am I losing on those trades? And have I created an ecosystem in my portfolio that's sustainable? Because my only ifs here, Pete, and you can talk to this a little bit deeper. My only ifs here is my win rate has to be larger than my loss rate, with my average profits being around how much I'm losing on average. Now, there's some black swan funds that, win 5 to 10% of the time, but they're, taking 10 to 20 times as much in their average profits than their losses. We'll get into that at the back end of the segment, but I at least want to hit you with this. This is how you tend to think about things, right, Pete, is winning more often than you're losing and not losing more than you're winning, right?
Right. And that's where, strategy comes into place. And whether that be strategy around extremes, strategy around pairs, all the different trading opportunities that we try to find edge on. And, I go back to this, and I know this doesn't feel like it's, real, for lack of a better phrase, but the largest, most successful market making firms in the world work on 52-48. And you think, how in the world can you make money on 52-40? I win 52% of the time, I lose 48% of the time. Now, granted, they're doing millions of contracts or shares every single day. And it starts to make sense. Okay, there's your edge. Now, what we're trying to do is, but they're very symmetrical about that. You'd think they have an edge. They would always count on that. And it speaks to their defined opportunity around low latency pairs trading within products, something we can't do, nor do we necessarily want to try to do? It's not a space where we're competitive. But this idea of managing, you expand that, and we look at probabilities around extremes in terms of prices. Static delta futures, just trading futures, is the true 50-50 bet. It's a coin toss. Nobody knows what the next second, hour, or day or week prices are going to be. So we want to take that 50-50 chance and expand it. Now, how far we can stretch the rubber band is an interesting part of determining what strategy we wanted to play. But if we don't keep this metric in place, no matter how clever we get, say we get out to 60-40, you would think that's gold. Well, 60-40 only works if you're symmetrical around your wins and losses in terms of average profit and loss, which is so important as we move forward. And, it doesn't mean that it always has to be this pegged one-to-one, but you have to be mindful. And for me, the determination, it's funny, and I know it's not paradoxical if you do it. When I look at strategy, then I look at mechanics to deploy that strategy. I always look at the bottom line of this before I look at the top line. I look at where can I determine a reasonable level that I want to manage this as a loss. Then I look at, is there an opportunity to make an appropriate amount to maintain this positive win rate?
Sure. And I'm super, super happy that you brought up that market maker, that kind of professional side of trading, because, although you might see it in movies like Wolf of Wall Street or like the movie Wall Street in general, where people are emotional, they're yelling at screens, they're yelling at this or that. At market making firms, Pete, you've gone to meetings with these people prior to COVID, and no one's yelling at at proprietary trading shops or market makers. Long gone are the days of people getting emotional and breaking screens and stuff like that, because they don't do this, which is, take a profit, and then dump all of it in one trade that they feel should have come back. They're very strict with that. And it doesn't mean that we have to be totally strict with it. It's just a matter of reducing this type of chart that you see before you here, even a little bit in your favor, because selling small stock 75, selling the stock market just in general, gave you a ton of opportunity in 2020. And this is not to say this is the best strategy. This is just an example of a strategy, which is, selling the stock market after it's had a big rally, going for a reversion play. And you look at this, Pete, and you've got, a nice winner in February, a nice winner in March, and then you're kind of stacking up some nice winners here throughout 2020. And then you get to that last 2 months of the year, and the stock market just took off, made new all-time highs, and then extended on them. And what you get here, if you've got no mechanics for managing losses in your futures trades, is $100, $200, $300, $400, $500, $600, $700 in profits stacked up along 7 short trades in the stock market throughout the year. And you dump all of it because you didn't manage your loss on that one trade. And that's why I'm glad that you bring up pros and market makers and everything down the line. They don't do this, right? Even your days in the pits, when you weren't even as mechanical as traders are in 2021, you didn't, take these profits on Monday, Tuesday, Wednesday, Thursday, and then on Friday just go home with 10 times that Monday through Thursday profit in losses, right? That's unsustainable.
Right. And you know what? You make a great point, because then human nature and human motion takes over. So the paradox is then you're adding more units to average out. Well, I like them here, they're higher now. And the flip side of that, so we've taken away symmetry around losses and gains. Now we've added another drag, which is the proclivity to add more units, because I think this trade is good. And if you think about that, that really destroys that win-loss ratio. Because if you're a one-lot trader and you've got 4 lots on and they're all losers because you are trying to recoup what you've got, you will never, in that case, you never have 4 lots on when they're all winners. Just think about that simple piece. And this is the cautionary tale about adding in a leverage product and the discipline around knowing your size of what you're starting with. Now, maybe you are a 3-lot trader and you're scaling in with 1 lot. Well, that's absolutely fine, but you know what your goal is trying to do and the management of that at that point. So this is, and it's such a great example that you brought up, Frank, when you let that become asymmetrical, and this is just sticking with a 1 lot, that's where emotion takes over, frustration takes over, because guys who have, you've heard this, you've started out the same way. I made money for 2 weeks and I gave it all back.
Sure.
And we've all said that and done that when we started out. And that's where we've let emotions and mechanics break down and this unsymmetrical relationship exists. It's so important that we find that with static deltas. Now, when we look at our options on futures, which are coming this year at the small exchange, there's a little bit different set of mechanics because we're finding opportunity that edge within the premium. But let's stick with what that's a perfect complement to static deltas. It's not an either or. We always talk about smalls and static deltas and options, smalls and ETFs. And this is an important piece we're going to keep not beating home because that sounds like, but empowering everyone with to balance these different opportunities because that's what we want, are opportunities.
Yeah, and I'm glad that you bring up, different products and options on smalls that are coming here this year and different strategies. Because this example is I just took the basic trade that I think a lot of people employ, which is, selling a strong stock market. But, it's not a matter of you got your one strategy that works 55% of the time, and then you just take those symmetrical wins and losses every time. No, when you add options and you add pairs and everything else down the line, just make sure you're finding a relationship that works. Like this second line here, I think is the way a lot of people think about option strategies like the strangle or iron condor, where it's like, okay, I'm winning 80% of the time. And when I do, I'm taking $100. So I can risk on those 20% of losers, $300. And that's still building a sustainable ecosystem. Like I had talked about a little bit earlier, that black swan fund type of thinking here, where it's like, all right, I'm winning less of the time, but when I'm winning, I am waiting for larger amounts of profits than those losses where I'm just taking quick losses. The place where you get in trouble with, Pete, is I think where a lot of people start out with bad mechanics, which is I gained my edge here. Okay. I got my 55-45 relationship in terms of win rate versus loss rate. But after that edge that I've gained in percentage terms, I've given it all away because I'm taking losses that are 2, 3, 4, 5 times the winners that I'm taking. Like you spoke to, I'm adding 1, 2, 3 more units when I have a losing trade on, as opposed to I'm not adding it all when I have a winning trade on. It's all a matter of finding a couple of those strategies, like selling a strong stock market, going against any trend, or pairs trading something, or whatever your strategy is, options and everything else, and just building strict mechanics around it that create an ecosystem that's sustainable. Because now we come back to the same relationship that we're looking at. And so maybe this loss here midway through the year, it goes from being green to red because I didn't wait for this thing to extend on me. I just took the loss. Sure, I ended up taking a loss on a trade that came back. But look over here. I sold the market 3 different times and I lost every time, but I lost $300 as opposed to just one short trade that went south from the start and I never managed. And now I've created a scenario where in 2020, I actually won at the end of the year on this short stock strategy. I have a P&L that is green at the end of 2020. This is what it's all about, managing losses in futures, Pete. It's about reducing the volatility of your returns, increasing your flexibility, and creating long-term profits.